What up, what up? Today I'm here with my guy, Jesse Hantla. We're going to be going over the top 10 frequently asked annuity questions. So Jesse, first of all, what the heck is an annuity and what are its benefits?
So an annuity is insurance for your money. And many times it's a program that we can go ahead and accumulate money over time, retirement plans, cash, whatever you have, to make sure it's protected from market risk, or it could turn into guaranteed income for life.
Okay. So why should we sell annuities?
One of the biggest reasons you get a ton of momentum in your business when you're incorporating that with life insurance, final expense, mortgage protection, because the payouts come in larger chunks. And on top of that, very, very, very low rate of chargebacks. My entire career, I've had one chargeback. And it was the first one I ever sold about 7 years ago. Since then, hasn't had any. I've actually had one free load in the first 30 days.
How many annuities have you sold?
Tens of millions of dollars at this point.
Let's go. Why do annuities have a bad reputation?
The big reason is because grandma and grandpa's annuities, right? And the way I was
the old school annuities.
Yep, the high fees, high commission, no safety in the market. And the big thing about it is innovation. You probably agree with me. The first iPhone you ever had, maybe first Android. No, you're an iPhone guy for life, right?
Of course.
I think I had an Android, and then as soon as the iPhone came out, I'm like, getting an iPhone. But the innovation from those first phones till today, how much better have they gotten?
A lot better.
So just like grandma and grandpa's annuity, high fees, no safety, where nowadays they've got the safety, the guaranteed growth. You've also got the guaranteed safety to where you can never lose money within the programs because of the floor. So if the market crashes, you've gained your money and it locks in at that time. And then the ability to grow your money and participate with the market, not in it.
Yeah, I would say, I mean, you've obviously sold many more annuities than I have, but when I would, sometimes when you bring up an annuity to a client, they're like, oh, we don't want that. And what I'll tell them is I'm like, oh, so you're probably thinking of your grandfather's annuity, where, John, there's different types of annuities.
Right.
And back in the day, there were guaranteed annuities, which was a guaranteed 3% interest, but that doesn't even outpace inflation.
Right.
And then you have your variable annuities, which you're getting a higher interest on your money.
Potentially.
But you can also lose money.
Yep.
But what we do is fixed index annuities,
right?
Where you're getting a much higher interest rate, but the floor is zero.
Right.
You can't lose any of your cash. And exactly what you said, it's insured and protected.
Yep. And the average growth that I've seen on some of these annuities, anywhere between 6 to 13% on a 10-year time stretch. But
there's no risk. That's huge.
It's huge because it's the same concept. If I give you $100 and you lose 50%, how much money you got?
$50.
Okay. And if you gain 50% back, how much you got?
$75.
Okay. So how much would it take if you're at 50 to get back even?
100%.
So the same thing is if we ever going backwards, like we can in a variable annuity or in the stock market, how much money does it take to get back? A lot of the times people are looking, well, I've got an average in my 401k of 10%, but I've had 10% downs, 20% ups, 30% downs. So we're riding this roller coaster up and down, and it's saying we have an average of 10% gains, but we've barely made 10% in our account. See, because we're going backwards, playing up, we're doing that. But if you could gain 10%, lock it, gain 5%, gain 10%, lock it, we don't get a zero. Let's say we don't get a return that year, we're not losing, it stays locked in at that point. So massive innovation. So grandma and grandpa's annuities no longer apply for us. And this is where we're able to help and protect our clients and put them in the best position moving forward, because you've probably come across this and the client says, well, Jesse, I could have more money and grow more in the market.
Of course.
Right?
That was going to be my next question.
Yeah.
Speaking of which, what's Warren Buffett's first rule of investing?
Never lose money.
Boom. Yep. What's rule number 2?
Never forget rule number 1.
Amen.
Yep.
Amen. So annuities sound great. So how old does someone have to be to qualify for an annuity?
Depends on the carrier, but typically 18 to 20.
Okay. 18 to 20.
Yeah. I've actually got a client, got her first annuity at 20 years old because she inherited a bunch of money. She said, I'm going to put money into an annuity, money into an infinite banking policy. So in 5 years from now, I can buy a new facility for my business.
Boom. All right. So basically the same age as to qualify for life insurance.
Yep.
When does an annuity make sense for a client?
At any age. Big thing about it is if you've got 401k or old money from a retirement plan, it's not necessarily when, but it's what are the objectives? What do you want to do? Are you concerned about losing money? Are you concerned with the growth? Are you concerned with guaranteed income? Now we're solving needs. It's not necessarily when, but those timeframes for a lot of clients can be between the age of 30 and 75.
Are there any fees associated with an annuity?
It's a good question. Many times there are fees within programs, but they're typically associated to a rider. Guaranteed income, additional liquidity, death benefit, protection riders. So if you're typically paying fees because there's an additional benefit.
Do annuities charge back?
No, very, very rarely. Like I mentioned, I've had one.
They can charge back though.
They can.
Okay.
I've had one charge back, but when you're working with a specialist, I would definitely say it's extremely helpful to understand suitability, because typically if they're ever charging back, it's because there was something that the agent missed, or the client was lying to you about how much they have. So in regards to what I'm trying to say there is, client may not have enough liquidity outside from the annuity, and we're just putting all their assets into the annuity. That doesn't make enough sense, because in the event of air conditioning on the house, the roof gets blown off by a tornado, or something breaks on the car, where are they going for money?
Their savings.
Their savings. But where would their savings be if they don't have any additional liquidity? Their annuity. So that's the big reason where that's an issue. So
Understood. What are the benefits of an annuity?
it feels like it's getting redundant, but guaranteed safety, lifetime income, benefits, probate free. In the event that the client ever dies, you can have funds paid out really fast. And on top of that, you've got the ability to grow it with a fixed rate. You've got the ability to participate with the market, specifically talking about fixed index annuities, participating in the upsides and never the down. That's a massive benefit. Guaranteed lifetime income, guaranteed safety, no risk, no cost, no loss, traditionally no fees, and only participating in the upside. It's massive benefit.
It's the downside. Sounds like a no-brainer.
That's what most of my clients say. Jesse, it sounds too good to be true. It only is too good to be true when you don't know the information, right? It's just learning new info. The downside is you do park your money for 7, 10, or 15 years, and somebody may need to have access to more money. And again, that falls back into suitability, making sure they have enough money on the side from what they're putting in. So if that emergency does pop up, we're not pulling money out of the annuity, because the downside is you would have a surrender charge. So the surrender charge is a fee if you're pulling out more than the free withdrawal amount. The free withdrawal amount is typically anywhere between 5 and 10%. And some programs have an upward of 20% if you're not pulling out money the prior year. Depending on it, you've got some liquidity. The only downside is the surrender charge. If it does have additional riders, having additional fees.
Lastly, last question. Does the client's health, does that have anything to do with the qualification process for an annuity?
No, not at all, because it's only for financial background. So if they've got debt, they've got enough money saved up outside of it, they have the ability to go ahead and get into the annuity. So huge.
Which is a great opportunity, because think about how many 60, 70, 80-year-olds we call where we've got a ton of money, ton of assets, savings, large home, and they're just really not interested in an equity protection plan.
Right.
This is a great opportunity for annuity. So it's phenomenal. Thank you for hopping on today, Josie.
Absolutely, brother. Thank you for having me.